Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying and What is Chen Selling. With regards to Chen's newsletter, it is now time to sign up. He does accept new subscribers during the first quarter of each calendar quarter. So starting tomorrow, he will be accepting new subscribers. So if you've got your name on the waiting list at miningstocks.com and you're interested in subscribing, tomorrow is the day to start doing so. You can also sign up for my newsletter at miningstocks.com anytime. Or you can call our office in New York at 718-457-1426, 718-457-1426 during normal business hours. But I do want to thank each of you for listening to this show, making it one of the more popular Voice America Business Channel shows. Also like to encourage you to continue sending your questions and comments along to questionsfortaylor@gmail.com. I'd also like to encourage you to follow me on Twitter. My handle is jtaylormedia. Also, want to thank our sponsors for making this show economically viable. Our sponsors for today's show, Novo Resources, Copper Bank Resources, and Calinex Mines. I titled today's show, How to Diversify When the Fed is Out of Patience. Our guest today will be Axel Merck. Gene Epstein will be with me in a few minutes, and I have with me momentarily here Michael Oliver, who we like to have on as often as possible for his views on some of the key markets. I think Michael really does outstanding work from a technical perspective, as good as any I know. So always pleased to have him with us as often as possible. In a moment when the markets think the Fed is stopping to, exactly at the time when people start thinking the Fed is going to stop pumping money into the system, as David Stockman says, the stock market throws a hissy fit, and whereupon the Fed then trots out before some Fed officer trots out before the microphones to utter a word of encouragement to stock investors, and that word was patience. It was the word that was used to cause the equity markets to turn around on a dime and go up like mad for a while. But they're playing this game back and forth. The Fed feels like they absolutely have to at some point start to tighten. And of course, they want interest rates to go up so that they're in a position where they can lower them again and manipulate the markets in that way from time to time. But the big lie that the Fed and our governments are constantly telling us that we can have whatever we want without paying for it, without paying a price for it, will, of course, at some time in the future come home to roost. Well, that's really why I'm a gold bug, because I honestly believe that printing money forever is going to ruin and is in the process of ruining our economy to a very great extent, and ultimately our currency. So gold is the guardian angel of financial truth, which is why the price of gold must be manipulated, in my view, lower by the liars and the satanic forces that control American laws and military force, I think. And the mindset of the population also needs to be manipulated to a great extent. But eventually, like Pinocchio's nose, that grows ever longer with each successive lie, the truth at some point can no longer be hidden. And so gold will one day become money again, in my view, not because government wants it to, but because the laws of nature will ultimately prevail. Axel Merck will be with me, as I'd mentioned, at about 1:30 the hour. He'll be with us to talk about the natural laws of economics and how we can prevail during the dark days when disastrous anti-free market economics are being forced upon us, and in the end actually turn those negatives into positives, perhaps, for our investment portfolios. And in just a few minutes, Gene Epstein will be with me again to talk about the upcoming New York City Junto meetings in Midtown Manhattan this coming Thursday. Gene will also have some things to say about the Federal Reserve patience and some of its other anti-free market behavior of late. Gene will join me in just a few minutes, as I say, after our first commercial break, but I'm really happy to say that Michael Oliver is with me now. And Michael always provides some great insights into the markets from his technical perspective. Thanks for joining me again, Michael.
Good to be back, Jay.
Always good to have you. On March 28th, your letter to your subscribers was titled Emergent Commodity Bull, A Process for Assessment and Entry. What are you seeing that suggests that we may be in for a more bullish environment for commodities in general, Michael?
Well, it's a mixed bag in terms of the net price trend, the obvious trends of certain markets. I mean, we have oil still depressed and falling. Lumber's under pressure. Cattle, I think, is going to drop back some. But net on balance, many of the markets, the grains, the precious metals in particular, have paid their dues and have done due diligence bottoming over a period of time. You can even see it on the price charts. But from a momentum perspective, just what I look at first, I see definitely what look to me like basing patterns, not continuation patterns for, sustained further decline. I don't see that. It's jumping off the page at me that I'm seeing the opposite, the type of warnings that I would expect to see of bottoming action. Again, it's not a unified chorus. So, if you take a metric like the Bloomberg Commodity Index, which is all the things, the lumber, oil, and grains and metals and so forth, it's got internals that are going different ways, just like the stock market does at times. But net on balance, I think we've, with the oil collapse, and there's probably some residue there, and probably some due diligence basing it's going to need to do. But net on balance, I think the multi-year decline in commodities is near the end, if not essentially over. I'm looking for leadership out of gold and silver. They happen to look most ripe in terms of the commodities within the index that look like they've based sufficiently. They just need to protrude out above the top of the base. And now that we have a new quarter, I've got some new numbers. If gold can get back up and trade to its three-quarter average, which is 12.1820 to be precise, do that anytime next quarter. That's not a breakout, but that tells me that those people who are still piling in on the short side of gold are wasting their bullets. That trade says I'm safe. A breakout in gold this quarter would be a monthly close over 1265, which is well ahead of the highs we made early in this quarter, which is the 1307. So momentum's going to break out there. Silver getting much over $17 on a monthly close will look very solid. So I'm looking at them as leaders, and I think if they emerge, I think a lot of others will follow.
Michael, do you see? Is this typical of gold and silver to follow, or do you not have an opinion on that?
Well, no, I have a bias on that. They tend to lead. Certainly in the last big commodity bull run in the 80s, it peaked in 1980, but began in 1976 for gold, and commodities bottomed in 77. So gold had a lead of about a year. It wasn't beating its chest, but it was definitely off its lows and on the way up. By the time the CRB index bottomed in the first half of 1977. So, and then also at the top, in 1980, gold peaked in January. Oil did not peak until October of 1980. So gold led the way both times, and I'm seeing that evidence now that if there's an upturn in commodities, focus on gold and silver, and if they emerge, I think you can be pretty well assured that then go to the grain markets would be the next place I'd look for upturning evidence, and that there's a bottom here.
All right, well, that's reassuring for those of us that have been long. What's that, Michael? That's
an asset category shift, like you were mentioning. Your subject this weekend is, asset categories, and that is, I would definitely shift more money into the commodity space.
Yeah, well, it's certainly a contrarian move, even aside from your technical work, but your technical work is suggesting that we've probably seen the worst of the downside for some. For the commodity complex as a whole, though there still could be some downside in oil, I guess, and you mentioned cattle as well, perhaps.
Yes.
Okay, but you also wrote on your weekend missive, you talked about the dollar, and it seems to be you're suggesting the dollar may be in a topping process here.
Yeah, I did a report 3 weeks ago on the way the dollar looked back in 2000, 2001 when it was peaking up at around 120 in price, dollar index I'm speaking of. Recently it got over 100. We're now at 98. I can see an intermediate pullback in the dollar probably might take you down to 95 on the dollar index, which is several points below where you are now. And in the interim of that type of pullback, which I don't see as a precipitous top. In other words, I don't think the drop from over 100 to 95 says that's it. I could easily see the dollar go back up again to the high, maybe even make a new high, but it begins a process, in my view, of what could be topping for the dollar. To expect the final easy top, I don't think is in the cards. But I've noticed this in many markets, that if there's a more or less a mama market out there that when it does something, you can't do something. But then when that market backs off, let's say the dollar, for example, the markets that might want to exploit that have an open door to exploit it. So if the dollar, in fact, does wobble off further over the next month or two, it'll be very interesting to see if gold and silver can exploit that open door and escape through their breakouts.
Mm-hmm. Well, earlier this year, we did see gold going up along with the dollar, but that's recently been broken.
That's entirely possible, yes. I agree with that, yeah.
We did see it, in fact, happening, at least for a few weeks. But you mentioned also in that same note, your weekend missive, that there's been quite a long basing pattern for gold. I think you mentioned 21 months or something like that. What does that mean? Does that pretend
it's sort of a message in a way. June 2013, gold hit 1180 after having been in excess of 1900 a few years prior. Mm-hmm. We closed this month at 1183. Mm-hmm. That was June 2013. We're talking 1 3/4 years, where gold is where it was 1 3/4 years ago. That's a message. Wow. Somebody's buying it down here. Now, of course, in terms of other currencies, the dollar is much higher than that versus the euro or the yen, for example. So in dollar terms, though it's sort of flat, it definitely is sideways. So I think there's a message there. Somebody is buying it. Somebody's. And despite all the sentiment on the negative side.
Yeah. Well, we certainly get the sentiment, the negative sentiment in the United States, in the Western world. There are other parts of the world where people look at gold a little differently than we do in the land of King Dollar, I suppose. You know, another interesting point that you made in another missive recently, Michael, we got just a couple of minutes here yet, but generally when this commodity complex turns around and heads more bullish, silver tends to lead gold, doesn't it?
Yes, that's I wouldn't call it a precise instrument of measurement, but it's definitely silver peaked, for example, months before gold did in 2011, and already hit it off its highs, substantially off its highs by the time gold peaked. Well, what that means is the spread between gold and silver began to disfavor silver. It had favored it all during the bull trend. For the last several years, silver has underperformed gold, been weaker on the downside, less strong on the upside. However, that spread is beginning to show signs of topping. By that I mean, right now it takes 71 point some odd ounces of silver to buy 1 ounce of gold. My work suggests if you ever break below 70, you do a weekly close and you divide the gold by the price of silver, and you find it's 69, let's say, ounces of silver versus to buy 1 ounce of gold. That is a trend change, and that's a multi-year trend change in that spread, which indicates that silver is now about to outperform gold. And that should be a positive sign for the net trend of those two metals.
Wow, very interesting. I think that is, there have been some other analysts that have observed that I've talked to in the past as well, and I guess those of us that have remained on the long side during this downside move for the precious metals, that's sort of music to our ears. At least we're hoping that there's a turn for those of us that have been wrongfully long for so long. Anything else? You know, I notice here, Michael, that we're down 150 on the Dow today as you and I are speaking. Just a quick note on how are you looking at the equity markets, the Dow and the S&P?
I think the equity markets are topping. I've had that conclusion since October, and especially in January. I'm talking U.S. equity markets in particular.
Yeah.
And I think that if you drop below 2050 on the S&P, especially down to about 2030 or a daily close anytime next month, which means, of course, next quarter, because the numbers change there, I think you've probably seen your top. I had been looking for a possibility of a 2130 S&P high, and we're not able to do that this year. We get up to 2119, I think, was the best we were able to achieve, slightly out above last year's high. But I think it's a topping process, and the evidence of the downside, in other words, payoff for the top, are those numbers I gave you, 2030 to 2050 area. Right now we're in the 2070s. So, again, we had a rally this past few days that attempted to go back to the high and wasn't able to, at least so far. I think their clock is running out. I measure time as well, not just price and momentum.
Sure.
And it looks to me like that if you want to make the case the S&P is going to trend higher, you better exploit that right now. If you don't, I think the clock's over.
Oh, very, very interesting, Michael. Thank you very much again. Your insights are always welcome, and I certainly enjoy reading your missives and would suggest to our listeners that they would do well to explore Michael's work. Also, especially for accredited investors, he does make available his service now. It's the website is olivermsa.com, olivermsa.com. So folks, go there, check out Michael's work. If you're a serious investor, you may want to consider subscribing to his letter. It is an excellent service. Thank you very much, Michael, for being with us once again.
Thank you, Jay. Bye-bye.